We're going to be looking back at the first 6 months of 2024 and where we could be headed for the rest of the year. Specifically, we'll look at interest rates, a very hot topic, buyer demand, homes for sale, prices, and affordability. So buckle up and make sure your trade tables are in their full upright position. Of course, we have to start off by looking at interest rates. Here's the 30-year fixed mortgage rate chart. We saw historically low rates from 2020 through early 2022. During these years, buyers took advantage of extraordinary low rates, which improved affordability. We see this when we look at the mortgage applications chart compared to interest rates. When rates fell, mortgage applications to purchase or refinance increased. However, once rates approached 5%, mortgage applications took a hit. Remember, a 1% increase in the rate raises the loan portion of the payment by 12%. In addition to the effect on buyers, those with mortgages that had refinanced didn't have any appetite to sell since they had refinanced into some pretty low mortgage payments. In fact, in January of 2024, Redfin reported that 79% of mortgage holders had an interest rate below 5%. 59% had a rate below 4%, and 23% had a rate below 3%. Wow. Some have called this the lock-in effect. The result was a significant decrease in sales. When rates retreated slightly, there was a small rise. This shows how sensitive buyer demand and affordability is to interest rates. When will buyer demand increase, you may ask? Watch the rates. This is why everyone is watching the Fed's fund rate. Just 8 months ago, back in December 2023, it was reported repeatedly that there would be 6 rate cuts for 2024. That prediction was as reliable as when Jerome Powell said that inflation was transitory.
If we do see that inflation expectations are moving up or inflation is on a path to remain well above our goals and risk of setting us off on a period of high inflation, then we'll use our tools to guide inflation back down to 2%. In the end, it will be transitory. And virtually all forecasters do believe that these things will come down of their own accord as the economy reopens.
The new consensus has been scaled back to 1 Fed funds rate adjustment in September. Believe it when you see it. Remember, the Fed's funds rate is not the mortgage interest rate, but does contribute to it. Let's move on to prices. This graph is the median home sales price for the greater Phoenix area. When interest rates hit 7%, affordability was crushed, and prices peaked in mid-2022, followed by a 13.5% drop by the end of the year. Since rates have been hovering around 7% since the beginning of 2024, what has happened to prices? And here's a big caveat. This is across the Phoenix Valley. Individual cities will vary. As they say, it's location, location, location. In some cities, prices have remained flat, but the overall median home sales price has increased 3.7% for the first 6 months of 2024. And this leads us to the next variable, which has been critical to home prices, and that's inventory or homes for sale. Compared to last year, the number of homes for sale for the greater Phoenix area has increased 60%. And this is where you need to do a deeper dive into the local market because it varies by city or location. We are still coming out of some crazy years where supply was severely impacted. And how do inventory levels compare to what was considered normal? According to the Cromford Report Supply Index, some cities are significantly below normal, while others are at or above normal, reinforcing the fact that it's hard to characterize all Phoenix real estate with a single blanket statement. As in past years, the number of homes for sale is significant when determining where prices will go. Now, you knew this question was coming. Are you finding value in this video? If so, please click on the like and subscribe buttons and hit that notification bell to be made aware of future real estate content. Let's move on to affordability. And this is a very interesting topic, and I believe will depend on your perspective. For example, a homeowner will be enthusiastic about home appreciation, right? I get it. Well, now put on your parenting hat as a father or mother. Do you want to see your children priced out of home ownership? I hope the honest answer is no. Let's look at affordability from a couple different viewpoints. The first one will be from a historical perspective. We all expect home prices to rise over time. Sometimes this is a predictable, gradual slope. Other times it strays from the norm and rises or falls unexpectedly. Are prices way out of whack? Well, that's a question that everyone has an opinion on. And here's a chart for the national median sales price with a 4% annual appreciation curve starting in 2001. While the median sales price has its ups and downs, it follows a 4% annual appreciation line pretty closely. From a national level, it appears that prices are very close to the appreciation line. And that's all good and fine, but we live in Arizona in the greater Phoenix metropolitan area. Now, here's a graph also going back to 2001 for homes under 2,500 square feet that compares the median sales price for Phoenix resale homes to a 5% annual appreciation curve. In this case, it shows the median price is above the 5% appreciation curve. Some could, with reason, say this is a signal that there's going to be a correction in the future, while others could rightly argue that prices will stabilize until the appreciation curve catches up. Time will tell. Graphs are nice and offer an interesting historical perspective, but a prospective buyer wants to know how affordable it is for their current situation. Let's approach it from that viewpoint. The question then becomes, how much does a household have to earn to afford a medium-priced home? This is an attempt to correlate a medium-priced home with an income level. So let's start with a $450,000 median home sales price in the Phoenix area. And assumptions have to be made. I chose an FHA loan with a 700 FICO credit score and 3.5% down payment. This translates into 6.25% interest rate and principal and interest rate of payment of $2,720 per month. Further assumptions include property taxes of $2,000 per year, insurance of $1,800 per year, $75 per month HOA, and mortgage insurance of $2,006 per month. Therefore, the principal, interest, taxes, and insurance plus HOA, or PITI plus HOA, is $3,318 per month. This is the monthly cost for the home. Now we have to factor in lifestyle considerations that can be considered as debt, such as car payments, credit card minimum payments, and student loans. Let's assume $1,000 per month. If a lender uses a debt-to-income ratio of 43%, then this means the household income for the median-priced Phoenix home must be $120,502. So, in summary, watch interest rates. When rates go down, this improves affordability tremendously and increases buyer demand, and may convince some sellers it is a better time to make that move than they had been thinking about, adding more listings to the market. If economic reports continue to show that the rate of inflation is under control and there is in fact an adjustment to the Fed's fund rate in September with possibly more to follow, expect rates to go down and buyers rejoice. Keep an eye on inventory. If the current upward trend continues, this will keep prices stable throughout the rest of the year. As we put the pandemic in the rearview mirror, stable prices would also allow that affordability gap we saw to decrease over time. Now, how these two variables interact, prices will adjust accordingly. Right now, we are trending towards a more balanced market, but as you know, things can change quickly. So we'll have to check in early 2025 and see how things worked out. In the meantime, you may have more questions, so please reach out to me at 480-326-8571. Thank you.